G'day folks, it's Jim here. It is Saturday the 26th of June. Well, last week I thought the dollar might add to the gains seen at the end of the previous week. That didn't actually eventuate, and it actually ended up weakening a little bit, and it gave up a little bit of ground against most of the majors, although I haven't lost faith in the fact that we could still see some dollar strength in the week ahead. And after a few days of consolidation, Wednesday through Friday of last week, it seems to me that we might have a decent sized move coming up, particularly I think in the euro. Elsewhere, precious metals consolidated following their decent sized fall on the 17th and 18th of June, I think it was, and both gold and silver do seem to be showing the possibility of carving out a bear flag in the days ahead. We'll go and have a look at that in a minute. Stocks have been mixed, but both the S&P and the Nasdaq, having reversed the losses of the previous Friday on Monday, they've ground very slowly higher. The Dow has yet to catch up and make a new all-time high, but the never-ending slow grind higher seems set to continue as solid US data seems to want to underpin the markets, and we have got the non-farm payrolls coming up at the end of the coming week. Domestically, the ASX is very choppy, having reached 7,400 the other day. It then saw that sharp sell-off and is slowly trying to regain those highs, but I very much doubt we're going to see anything eventuate really until we see the possibility of renewed buying interest in the new financial year, which begins on the 1st of July. As far as the calendar is concerned for the coming week, it's pretty thin on the ground until we get the non-farm payrolls on Friday. The main events ahead of that will be we've got the German and the EU CPI. We've got some Chinese PMIs, manufacturing PMIs come out. They'll be important, particularly for the Aussie dollar. We've got the Q1 UK GDP, and then in the States we've got the ADP private employment figures and the manufacturing ISM, but all eyes really are going to be on the non-farm payrolls numbers on Friday. The expectations there are for a growth of 645,000 jobs and a headline employment rate of 5.8%. And also don't forget it's going to thin out a little bit, I think, later in the week, because the following week will be the July the 4th US holiday, and it wouldn't surprise to see a lot of people packing up early and heading off for a long weekend. Anyway, without further ado, we'll go and have a look at the chart, starting with the dollar index as per normal. Okay, so here we have a daily chart of the dollar index. Now, this is the close on the previous Friday. We closed, as far as the dollar is concerned, quite a bullish mode. But really since then we gave back a bit of ground on Monday, and really since then we've just traded sideways. Let me just blow that up a bit. So we've really just traded sideways. We've carved out 3 dojis actually. That suggests we've got quite a move ahead of us at some stage. The daily indicators, the momentum indicators, still pointing slightly higher. But what I'm really eyeing up now is this particular resistance here and the possibility of it being a reverse head and shoulders. So I haven't lost all faith in the fact that we could see some dollar strength ahead. We're sitting right on support here, which is the 200-day moving average. That's at 91.5. If we do get below there, the 100-day moving average comes in at sort of just above 91. We might not do an awful lot early in the week given the sparseness of the calendar, but if we can take out this high here, 92.40, and then particularly if we take out this 92.85 level, this being the neckline, then we could really see quite a move to the top side, being equidistant from this low here to the neckline. That would take us up to sort of this level here, which is the 50% equidistant of the whole move down in the dollar index from 103 back down to here at just above 89. So that's kind of what I'm still thinking, that we might be carving out a bit of a bull flag for a move higher. If I'm wrong, well, if we break back below the 100-day moving average now, then I suspect we're probably going to see a slow choppy move back down here towards this 89.60 level. The reason I say slow is because we're heading into the Northern Hemisphere holidays, and interest and liquidity are going to be relatively thin for the next month or so.
Anyway, without further ado, we'll go. Actually, I'm just going to have a look at the weekly charts while we're here. And as you can see, the weeklies are also, the momentum indicators seem to be pointing higher. So I kind of like this formation here. And as I say, if we can break above it, then we head to this 38.2 and possibly the 50% equidistant move from the base to the neckline. That's a long way off at this stage, and I wouldn't be getting overly excited right now. But we'll go and have a look at the euro and see what that tells us. Okay, so here we have a daily chart of the euro. Let me just blow that up a little bit. And as you can see, we've got that neckline that I was just speaking about in the dollar index. That comes in here. That's at around just 117.5 or so. But closing this up again, if we before then, this rising trend support here comes in at 118.60. So that's going to be the first port of call if we are to see dollar strength, and then 117.60 below there. If that gives way and this this head and shoulders comes into fruition, then we can see a move back down to 110.60 or so over time. The daily indicators are looking at, well, a little bit oversold, but they still look heavy to me. The stochastics are recovering as they're the more sensitive of the indicators, and they are recovering a little bit from that sell-off of the previous week. If we come back nearer home and look at the 4-hour charts, the MACDs are actually pointing a little bit higher, but as I said last week, I think so anything in the sort of 120 area, possibly around this low here, 119.85, up to sort of 120.5, somewhere in that level area, I would be looking to sell into it, because I haven't given up hope on the fact that we are going to take out this low here, 118.5, head back down to the rising trend support eventually at 117.60. So we'll have to see how that eventuates early in the week. Really, Monday, Tuesday, it wouldn't really surprise me to see us track sideways in the sort of 119 to 119.60, 70 area. We did get up to here to 119.70 on Friday. That was after the US data, but the US dollar clawed back those losses and finished back towards Friday's lows, and we'll have to see on Monday, but a couple of sideways days would not really surprise me. So moving forward to dollar yen. Now dollar yen actually managed to reach levels last seen in March 2020, got up here to sort of 111.10 level. We need to go and look at the dailies. So as you can see, 111.10, we haven't been up there since March 2020. Didn't close above there though, but it hung in above 110.5, and I think it looks relatively good, although I'm a bit dubious about the bearish divergence that we're seeing on the dailies, making new highs, but the RSIs and the MACDs do seem to be running out of steam. But for the time being, I think you probably have to stay with the trend. And if we just draw in that rising trend line, you can see that there's good support coming in here now at this 110 level. So a break below there would have me worried. So I think possibly buying dips towards 110, 110 and a quarter, 110 and a half, with a stop loss below 110 is probably a decent trade, because you know where your stop's going to be. It'll be where everybody else is if we do break 110, and it might actually be worth putting a stop and reverse on, because if it does go below there, then we're possibly looking to move back down towards 109, and it possibly even the 100-day moving average at 108.60. That's some way off at the moment, but really the trend's your friend. So maybe we're looking for a break of that 111.10, and if we do go higher, well, that 111.30 perhaps, 111.70, and what's this high up here? That's just above 112. So over time we might, it's going to be choppy I think, but over time we might just see a slow drift higher. Don't forget we have got the Tokyo Olympics coming up in a few weeks time now, and given the state of the pandemic and the recent emergency in Tokyo, that could see some added fluctuation in the yen, depending on how the news headlines come out. So definitely I would be keeping a tight stop in place on the downside. Moving along to cable, and that's pretty choppy without doing an awful lot. Let's go and have a look at the 4-hour charts. It did recover from the lows of the previous week. Sterling actually made it to about 139.5, but it's given up some ground. It's come back to 138.75, and it's basically sitting near, now let me go out to the weeklies, it's sitting near this pivot line that we've been watching for quite some time now. I think there's better trades out there than cable. The weekly charts aren't really telling us a lot. The dailies possibly pointing lower. I'd rather be short than long, I think, but I like to keep a stop loss above last week's high. Call it above 140. I think I put a stop loss up there. So maybe selling it towards the 100-day moving average. What is that? 139 and a half with a stop loss above 140. But looking for a return to 137.80. And if we were to break that, these lows here, and then the 200-day moving average above 136. So that's probably a bit further out. But the dailies, if anything, are showing us that they're a little bit heavy. And like I say, I prefer the downside to the top side. I won't get involved in dollar Swiss. The Aussie had quite a good week. I had a bit of a short position on, got stopped out when it went above 76 cents. Wasn't very special. The 4 hourlies, they recovered from their oversold situation. Now they're turning a little bit more neutral. The dailies equally not telling us an awful lot. And as far as the charts go, let me blow this up. We have recovered from the losses below the 200-day moving average. We're now back between the 200 and the 100 on the top side, the 100 being around 77 cents. The dailies are not telling us an awful lot, but I think I'm a bit torn on the Aussie. It really depends how the headlines turn out with regarding global growth. If global growth slows and commodity prices come lower, then I think the Aussie is going to be fighting heavy headwinds. But if the US really begins to pick up and global demand picks up, the Aussie should be doing all right. I'm not overly bearish. I think if you saw it back down here, sort of 74.5 and below, I'd probably be looking for levels to buy it for the longer term, because I do think eventually we're probably heading back towards sort of that 76, 77 cents. This previous high up here, 78.80, looks a little bit unattainable at the moment. But it wouldn't surprise me 6 months' time if we're back up there. But as I say, it all depends on the global growth story, really. I won't go into the Kiwi. That's pretty much the same as the Aussie as far as the outlook's concerned. But we'll go and have a quick look at the metals. And here we have a 4-hour chart of gold. And as I said earlier, it seems to me that they might be carving out a bit of a bear flag. The same really applies. Let's have a quick look at the 4-hour silver chart. Same really applies to silver. And you know, it seems to me if this is a bear flag, then we're headed back down to these lows here at sort of 24.5 or so. But back to gold, I think for the time being you use sort of 1800 as your resistance, and you use 1760 as your support, and go with either direction. Above 1800 would really negate my bearish outlook, because the daily, let's go to the daily charts. Here we have, well, the 100-day moving average is 1795, and if that breaks, so 1800 breaks, then I think we're probably headed quickly to the 200-day moving average around 1835, and if that were to give up, then we head back up towards that 1900. That seems some way off at the moment, given that the daily charts do look still heavy. So if this is a if we were to break this 1760 level, then I suspect we can head back down to this sort of 1670, 1680 level, where for the longer term I'd still be looking to buy it, but that's too early to work out at this point in time. Briefly onto the stock indices, and here we have the S&P 4-hour chart. Like I say, the trends your friend. We did have this nasty sell-off over Monday, but it really just came back down to stop out some of the weaker longs before recovering throughout the week. Really just a slow grind higher. Monday saw a decent move, but then since then it's just been very slow grind higher. But we're marching in on 4300, which I guess is what we were looking for a couple of months ago. The 4-hour charts for the beginning of the week look relatively positive. The dailies less so, but they're not overbought, they're not oversold. They do look fairly neutral. And at this point in time, let me just update that FIBO. It looks to me as though the slow grind higher can continue, with stop losses now being placed at sort of 41.5, or even better below this sort of 40-60 level, which is where the 100-day moving average lives. The Nasdaq's the same. The S&P, I won't go into the other US indices. The Aussie index, this is the SPY. It's trading at 72.13. And this is the ASX 200, which is trading at 72.90. It did get above 7,300 last week. But going back to the SPY on the 4-hour charts, we've got this minor resistance here just above 7,300, and the all-time high is at 73.60. So I'm hoping that given the new financial year on July the 1st, we'll probably consolidate and chop around till then. But I'm hoping that we do see a move to new highs. Let's have a look at the dailies. They're not really very positive at the moment. So the weeklies not really showing as much either, possibly a bit of a topping out situation, if anything. But we're just chopping sideways. I wouldn't get too perturbed about it. I don't really expect to see anything early in the week. As far as the ASX 200 goes, as I say, that's just trading below 7,300. The all-time high here at 74.02. And we really need to get above that before we can see new ground. The dailies, once again, pretty immaterial. They're not doing a great deal. I should say the support level, by the way, on the ASX 200 is down around. It's somewhere away, really. It's 250 points away. They're minor support up here, 71.90 or 7,200. If that were to give way, then 70.30 and the 100-day moving average at below 7,000 would be targets, but I don't really see that happening for now. My own view is continue to buy dips. I think eventually the market will move higher, and I think we're going to see a move above 7,400, and longer term I think we couldn't go an awful lot higher, but time will tell. We'll have to wait and see on that one. Finally, I'll have a quick look at oil. Okay, here we have a 4-hour chart of West Texas Intermediate, and really, as with the US stock market and the global economic growth story, we're just seeing a slow grind higher. 74, it closed at $74 a barrel, and I think it's probably going higher. I'm not sure I'm game enough to buy it at these levels up here, but I guess if we come back down to this was 61.8% levels, which is below, that's back below 70, that's some way off now. But if we saw it back down towards 70, maybe be a bar there, because I think the next target up here just above 77, and then the 76.4% FIBO level, which is still some way off, that's well above 80. But I think that's the direction of it. So I definitely would rather be long than short. If you were to buy it near $70 a barrel, if we're lucky enough to be able to do so, let me go back to the dailies. Actually, I need to go to the 4-hourlies. Okay, so there's going to be minor support here around these lows here, so 72.20. Below there's not an awful lot until this first FIBO level comes in. That's just above 70. So I'd probably be buying it down towards that level. If we were to break this low here, which is what, just 69.75, I think I'd be out of it. The 4-hour chart's not showing us an awful lot at the moment, but like I say, I'd rather be long than short. But I'm not really brave enough to buy it at these kind of levels, and I think there's possibly easier trades out there. Just bide your time with oil, I think, and look for a dip, wait for a dip, and get in on that, and then set your stop loss accordingly. Okay, so that's about it. We'll have a quick look at the calendar. Okay, there's not an awful lot out early in the week, although there's various Fed speakers who will be providing us with their views on tapering and interest rate hikes. So that's probably going to be the most important factor early in the week. Tuesday, not an awful lot apart from the German CPI figures for June and some secondary US data. Wednesday sees the Chinese manufacturing and non-manufacturing PMIs, and then later on the UK first quarter GDP figures. We also get the EU CPI and the US ADP numbers, expected to show 600,000 jobs created in June. Then once again, there's not an awful lot. We've got the Q2 Japanese Tankan. Nobody ever really takes much notice of that, but it's worth keeping an eye on. The Australian trade balance comes out, and then we've got the Kaizen manufacturing Chinese PMI, so we might see a bit of action in the Aussie on Thursday. But really, it's all we have got the EU manufacturing PMIs on Thursday as well. But in reality, the ISM as well, ISM manufacturing PMI. But in reality, as I say, it's going to be the US non-farm payrolls, 675,000 jobs expected to be created, with the unemployment rate dropping to 5.6%. We'll have to wait and see on that one. But that's about it for the coming week. I hope that helps. Have a good week's trading, and we'll talk to you next week. Cheers.